Welcome to the Retire Right podcast with Larry Heller. You deserve complete financial advice. There's no acceptable alternative if you want a plan to live well and on your terms. Complete financial advice equals complete peace of mind. Now, let's get into this week's podcast episode.
Hello and welcome to Retire Right with Larry Heller from Heller Wealth Management. Larry, it's been too long since I've talked to you last. What's going on?
It's been a while. How you doing, Eric? Everything's great here.
That's good. Same here, just busy, and it's, time. I swear that I don't know how these years work, and maybe it's just because I'm older, but the end of the year just goes really, really quick. I feel like I'm about to eat turkey, and then I'll have a Christmas tree right in front of me. I mean, it's just that quick. It's boom, boom.
I just had a conversation with somebody who said same thing. As we get older, the years go by so quick, so much quicker.
Yeah.
I still think it's 1999 and the computers are going to stop working when the clock changes.
Well, fun fact, I actually I worked at Amazon.com upgrading their stuff before the 2000 hit. So you're welcome, Larry.
All right, thank you very much.
yeah, that was a good time. I enjoyed
right, that was only like 5 years ago, right?
Yeah, just a couple of years back. Yeah, absolutely. All right, so we didn't come here to talk about how old we are. Larry, what are we talking about today?
So we're going to talk about taxes and how to save money on your taxes. I know everyone wants to talk about investments and sexy stuff. I know my last podcast we talked about investing in boring. So, but that was really investment strategies. Today we're going to talk about what you should be doing, or what is your advisor doing, or what is your advisor not doing, and things that you may not be aware of that you should ask your advisor, are they doing? And if not, they should be doing. So we're going to talk about some of the strategies that we do ourselves for our clients.
Yeah, if I've learned anything from you, Larry, is that if you listen and learn how to save money on taxes and how to save money in these different things that you've talked about on many podcasts, then you have that money to use to go ahead and buy sexy investments, right?
Yeah, absolutely.
If that's what you want to do.
Or more importantly, that you can compound that money so that you can retire earlier or make that money last longer for you.
There you go. Absolutely. All right. So where do we start today? I know it's a big subject.
Okay. So just taxes alone, when it comes to investing. So it's not how much money you make, it's how much money you keep. So if you have investments and you're paying a lot of taxes because that's ordinary income taxes, not capital gain taxes, and there are two different versions which we'll talk about, then you're not able to have this extra money. So how can you make money? How can you keep money? By lowering the amount of taxes you pay. Now, of course, taxes should not be the sole reason to sell an investment or to make a decision about your investments, but there are still plenty of ways to maximize your return by minimizing your taxes. So let's talk about some of the strategies, and I'm going to try to do as basic here as I can. Feel free, Eric, to ask some questions here.
All right.
So the first thing I want to talk about is cost basis. So what is the cost basis? So when you buy a stock, if you buy it for $1,000, that is your cost basis in it. And then if you have dividends and capital gains that are reinvesting each year, you got to pay taxes, or you may have to pay taxes on that, but that adds to your cost basis. So let's say you started with $1,000 and you had $200 worth of capital gains and dividends over the year. So now that added to the $1,000. So now your cost basis is $1,200. Now you want to go and sell some or all of these mutual funds, these investments. So believe it or not, there are different ways to determine how much your gain is and therefore how much you own taxes. So I'll just briefly talk about the 4 different ways of determining what the gain is. And one of them is average cost. So average cost is, let's say you buy a mutual fund and the first time you bought it and the price was $20. And then later on, you bought the same mutual fund and the price was $40. And now you want to go sell the entire fund. Well, you take the $20 that you bought, assuming you bought the same amount at both times, and the $40, and you have an average cost of what would the average cost be, Eric?
$30.
There you go. So now, if your average cost now is $30 and you're selling it for $50, you have a $20 gain.
Mm-hmm. Okay, that makes sense.
So that makes sense. So that's one method. And once you select the method, you have to stay with the method throughout the time that you're investing. So strategy number 2, cost basis number 2, is what's called FIFO, first in, first out. So now let's say you have, we talked about the first part, the first tranche that you bought of this mutual fund was $20. And now you're selling part of it. You're not selling all of it. And so you're still selling $50 worth, but you're only selling the amount of shares that you bought. And this time, instead of using the average cost of $30, they're going to use the price that you paid in the beginning, the $20 one.
Okay.
So now your gain is $30, 50 minus 20 instead of 50 minus 30.
So that's not good.
That's not good. The third method is Lifo. So Lifo here, now you're doing the same thing, but now you're using the shares that you bought last in, first out. So now that is at $40. So now your gain is only $10. So you have 3 different methods here, and depending upon the price here, which is going to be the best method? Well, we don't know, because maybe the method is going to be the average cost. Maybe it's the FIFO. Maybe it's the Lifo. You don't really know, depending upon the price at the time. Of course, usually the stock will go up, so that means the price that you bought last, you would pay the least amount of taxes now. But later on, when you want to sell the rest and have used up all of the Lifo basis, now maybe you're later in life and you have all that's left is your earlier stock prices, your purchase prices. So you may be paying higher taxes later on. And just the opposite with the FIFO. That's why most people choose the average cost basis, so it blends the two together.
Okay.
But the strategy that we use, and the one that is the best, is really, we think is the best, is the specific identification method. So now what can you do with this? Now, anytime you go to sell, you can actually select the lots that you want to. So now let's say you're decided to sell and you want to sell with the highest lots. You would go in and identify the actual lots that had the highest cost. Therefore, you would have the lowest gains.
Okay.
But let's say you're in a year, and we're going to talk about tax rates in a minute, but let's say you're in a year where you're in a very low tax bracket and possibly have zero capital gains. Yes, you could have zero capital gains. Or you're now not working that year and you're not earning money. So you want to go in and identify some of your lower cost basis. So you can now identify the lower cost basis. And of course, you can go in, and if you're going to sell, you can sell some from the lower, some from the higher. So you get to pick and choose which ones you want to do. And by doing that, you can control the cost basis you select, and you can control what the taxes are. Now, of course, doing this manually over years and years and years, because every time there's a dividend and there's a capital gain, there's a different lot, could get very, very, very onerous. So we use a computer program that would actually do that. We tell the computer program what we're trying to do, and they identify the lots, and they automatically sell the ones that we do based upon the strategy that we're using.
Nice.
So knowing the cost basis and knowing the method that you're selecting, and I would guess if you ask the average investor what method they're using for cost basis, they're going to have no clue what that is.
Yeah. Yep.
So for all those out there, go ask your advisor, what method do you use when it comes to identifying and using for mutual funds? Again, most firms are going to use average cost basis.
Yeah, and here's the thing. like you said, if you ask most if you ask most investors that question, you're going to get a deer in the headlights look, right? And I would say for any investor out there that has an advisor, if you ask your advisor that and you get the deer in the headlights look, it's time to call another advisor.
Right. Or even if you don't and they understand it, a lot of the firms don't have the software to do the specific identification because it's much more time consuming.
All right. Well, that's good to know.
So let's talk about strategy number 2, which also plays a little bit on the cost basis, but it's a little bit more. So I'm going to talk about capital gains. And again, I'm focusing today on mutual funds. Or they could be ETFs as well. But talking about mutual funds and ETFs, when you buy a fund over time, depending upon the cost basis and depending upon how the fund has done, hopefully you're going to make money on that. But until you sell the fund, it is an unrealized gain. Once you sell the fund, then it's a realized gain, and you got to pay the difference between the selling price and the cost basis. So, knowing what bracket you are in has got some very great and very powerful ways of identifying certain assets that you may want to sell at certain particular times. So let's talk about that. Now let's talk about the different brackets. So when it comes to capital gains right now, and we are doing this podcast on October 22nd, and I'm quantifying that because by the time it comes out, there's a possibility that the rates may have changed as the House is looking into a new tax law. But right now, there's 3 different brackets. There is 0% capital gain bracket, there's a 15% capital gain bracket, and there's a 20% capital gain bracket. And these are for investments that are held more than 1 year. If you sell something less than 1 year, it's called the short-term capital gain, and it's taxed based upon your ordinary income bracket. So if you are married and filing joint, and you earn less than $80,000, your capital gains are 0. That's right, 0. If you're earned between $80,000 and $496,000, your capital gains are 15%. And if you earn more than $496,000, your capital gain rate is at 20%. So again, we're not going to let the tax rate make the final decision here. But let's say you're in a year, for whatever reason, coming out of the pandemic, you're in a year that you had some bigger losses and that offset a lot of your taxable income. So you have 0 income this year, and you're thinking about rebalancing or taking some profits from some of the money this year. And next year, you're going to be in a higher income. You're making more money. Well, if you took some capital gains this year before the end of the year and you've kept your income under 80,000 and your profit, let's say your profit was 20,000, now you're getting to keep all that 20,000. But if you wait till next year when your income is higher, now you got to pay 15%. And we're only talking federal taxes here. But you just saved money by making sure that you sold during a year where you have lower gains. And that also goes through if you're possibly on the limit between the 496 and above, and you're thinking about doing this. So if you're looking to rebalance or taking some profits now towards the end of the year and you're calling your advisor should say, what tax bracket are you in? Is maybe we should wait a little bit as we get closer to the end of the year and take more in next year. Or if you're planning on taking some in next year, they should be reaching out to you and saying, what's your bracket this year? Maybe we should move some of the gains in this year when we're rebalancing. So knowing what bracket you're in may have some impact on how to save some money on your taxes.
Yeah.
Now the single rates aren't as generous as the married are, but it still applies for your single capital gains. So knowing what bracket you're in really has an impact on what your taxes are.
Yeah, sounds like it. And obviously, most people don't know what bracket they're in, but if you tell your accountant or your advisor how much you've earned, they should be able to tell you immediately, right?
Yes, and they can look at any advisor should be looking at your tax return, and they can figure out what it was last year and see if it's about the same this year.
Got
it. And calculate that. Again, you just have to know the 3 different breakpoints and see where you are. So you don't need to know it exact. You just need to know, is it going to be above this, below this number, and where it's going to be making those decisions. And again, that may not come into play because you may want to be selling something because you think it's time to change things or rebalance things. So, but if there are ways and there are certain scenarios, why not save money? I mean, we've had scenarios where clients were planning on buying a home in the first year. We needed to raise a substantial sum of money. So looking at this and trying to figure out how to minimize those taxes to save some money is well worth it.
Mm-hmm. All right.
So let's talk about, again, a little bit more about capital gains, but let's talk about mutual fund distributions. And this sometimes gets, again, the deer in the headlights that you mentioned before for for the average investor. Sometimes also they don't understand this. So when you buy a mutual fund, you buy into a fund, and so are a lot of other investors. And whether it's a index mutual fund or an active mutual fund, anytime they sell a stock inside this mutual fund, and if they sold it as a profit, there's a capital gain. And guess what? Those capital gain distributions are passed down to you, the mutual fund holder. So one of the things that happens, and it happens in years when there may be a big decline at the end of the year, but during the year, the manager was buying and selling the funds inside, or they needed to raise money and they were buying and selling, the mutual fund actually could be down, and then you're getting a large capital gain distribution at the end of the year that you have to pay taxes on. And the investor's like, wait a minute, I lost money on my mutual fund. Why am I paying all these taxes on these capital gains? And that's because the mutual fund has distributions. So one of the things you should be looking for on a fund that we look at is, what is the turnover of the fund? If it's an active manager that keeps buying and selling, even though they may be making money, and they also could be losing money, but on the funds that they're making and the ones that they sell and the turnover, you're going to pay taxes on it. And if they don't wait a year on all these funds, all these stocks, you could be paying ordinary taxes. So looking at the mutual funds that you have and looking at it, if you want to look at Morningstar, you can actually see what the turnover percentage is. And some of the funds, sometimes I've seen 100%. I mean, these are really aggressive funds out there. So knowing what kind of turnover you have in your funds and asking your advisor what the turnover rate is will kind of determine some of the distributions that you can expect. Year-end distributions. So again, we talked about the capital gains that are being bought and sold, and a lot of times these distributions are not distributed when you are a record of holder. So at the end of the year, sometimes the funds are going to distribute some large gains. So even though you might have been buying the fund now, so we talk about this, if you've given your advisor new money to invest and he invested the day before that you're the record of a mutual fund holder, and they distribute their distributions shortly thereafter, you're paying taxes on those capital gains, even if you might have only owned the fund for a very short period of time. So if you plan on investing towards the end of the year, you may want to wait until after these distributions are made so you don't have to pay capital gains on these distributions.
Yeah, that doesn't seem quite fair.
It doesn't seem quite fair. Now, again, some funds distribute them quarterly, some annually. So knowing when they do that, it's not fair. but it's all impact your taxes. And one of the reasons why we use funds that have not only low turnover, but we use funds that are more buy and hold strategies. So therefore, there's less active trading, less capital gain distributions. Less capital gain distributions lead to what, Eric?
Less taxes paid.
Bingo. You got it.
We like that.
Exactly.
I'm following you, Larry.
Okay. All right. Let's talk a little bit about single stocks. And this can get a little complicated as far as some of the strategies that you can do. So I'm going to try to keep it really simple, but it's becoming a little bit of a issue now because we're seeing a lot of clients and a lot of potential clients that may have some large gains because they bought Apple or Netflix or Facebook at very low numbers. And now these stocks are becoming a big part of what their portfolio is. And if they want to diversify out, they're going to have to pay some taxes on that. So what can you do? Now, we've talked about the specific identification, and that's easy to do on stocks. But there are also other strategies that you can do. And there are a few different what we call platforms that will take the individual stock and diversify it into a basket or a large amount of stocks. And what do they do once you have these large amount of stocks? Well, they would actually look to harvest losses. Now, what does that mean? Well, let's say you owned Pepsi and you have this individual stock, you sold some of this individual stock and you bought 1,000 other stocks, all within a managed account. And then we know that some of these $1,000 other stocks are they're not all going to go up right away. Some of them are going to go down. So I'm just taking an example of Pepsi. Let's say Pepsi was one of those stocks that went down. So the computer system or the manager could decide they're going to sell Pepsi and they're going to buy Coke because they're going to think same sector, similar performance. So what have they done now? They've now sold Pepsi at a loss, and that loss can be used to offset the gain that you did on when you sold that individual stock. And the nice thing about a lot of these computer programs, they're done so quickly, so fast, and they're constantly selling when some of these individual stocks are done. I've seen instances where the market went down right after we did this. We were able to harvest hundreds of $1,000s of losses and able to offset some of these gains. So I know this strategy may seem a little complicated, but we can explain it even more. So if you are sitting there with an individual stock or a few stocks with some low cost basis and want to diversify out, please give us a call and we can talk about some of these strategies.
Yeah. And again, it goes back to what you've said time and time again on this podcast is that everybody's situation is individual and they need to speak with a professional to be able to, know what strategy is going to be best for them. So this was pretty complicated so far today, but I was following, Larry. I promise I was following. And there was a lot of good news in it.
Yeah, there is good news. And speaking of tax loss harvesting, there I was talking about an individual stock, but you can also do the same thing on a mutual fund. We've had instances where at the beginning of 2020, when the pandemic hit, if you would have invested money right away, what you want, if your advisor just sits there and does nothing, you're losing this great opportunity to sell a fund and to buy a similar fund. Now, when you do it with a fund, what you need to do, you need to wait 30 days to rebuy the same fund. So let's say you bought XYZ fund and you bought it at the wrong time. The market takes a big nosedive and we want to harvest some of these losses. So we're going to buy ABC funds, basically a very similar fund to XYZ fund, and we're going to hold that fund for 30 days. And then at the end of 30 days, we're going to sell ABC fund and going back to XYZ fund. So now what did we do? You're in the same exact fund as you were before, but now you have these realized capital gains, realized capital losses that you can use to offset future capital gains. And you're in the same position, but if you did nothing, you would not have had these losses that we booked into realized losses. And the reason why we do this is if the market runs away from you in those 30 days, then you would just hold on to ABC fund and you'd be in the same position if you did nothing. So we call this tax loss harvesting. So again, another strategy that your advisor should have in case this does happen.
Okay, great advice.
One last one. Again, we're going to probably have a separate podcast just talking about charitable contributions and investing and possibly using your IRA. If you're inclined to do a charitable contribution and you're in the standard deduction and you can't deduct your charitable gift, there are ways of using your IRA as a charity. And now you're actually lowering the amount of your IRA and lowering the amount of your required minimum distribution. Whereas if you just gave a gift outright, your money, you would still be down the same money, but you wouldn't have gotten a tax loss, so a tax deduction. So it's just another way of doing that. So again, having these conversations with your advisor and saying, hey, I'm planning on doing a charitable contribution. Am I better off doing it with cash or am I better off using my IRA? Those are some of the conversations that you should have. So these are some of the strategies that you used to lower the taxes. And again, when you lower your taxes, more money in your pocket. Isn't that what everyone wants, Eric?
Yeah. More money in every pocket, Larry.
Absolutely.
For sure. All right. So again, I know that you're always open to a phone call. How do people get a hold of you if they want to chat about this kind of stuff?
Yeah. So I want to be clear. I mean, all these strategies are not for everybody. They're not specific recommendations. Mm-hmm. So we would need to speak to you to see what your situation is. Every client is different. Every strategy is different. So if they'd like to talk to us and thinking about some of these strategies or anything else, they can go to our website, Hello Wealth Management, and click on the schedule a free assessment, free 20-minute assessments to see how we can save you money on taxes. Or you can feel free to call the office at 631-293-2806.
Fantastic. Larry, again, this was a pretty meaty podcast. And then the nice thing is people can rewind and listen again. I'm hoping that they're doing that to take a few notes and then reach out and call you. So thank you so much for your time today. And our last thank you always goes to you, the listening audience. Thank you so much for tuning in and listening to the Retire Right podcast with Larry Heller. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Larry comes out with a new podcast, it'll show up directly on your listening device. This makes it really easy to share these podcasts with your friends and family. Again, thanks for listening today. For everyone at Hello Wealth Management, this is Eric Johnson reminding you to live your best day every day, and we'll see you next time.